Robinson. Danger. No, Will Robinson. Danger.
Hey everybody, welcome to a special ANDIKA Bulletin video presentation. Today I'd like to talk about the ASX 200. Did you know that the ASX 200 is only 1.5% away from its all-time record high of 7,628 points, which is where it reached on the 13th of August 2021. Now, there's a lot of headwinds facing the markets today. We've got inflation sitting at 7.8%. We've still got, I believe, a hawkish RBA who next Tuesday will be looking at their 9th interest rate rise to take the cash rate probably from 3.1 to 3.35%. I'm suggesting they'll do a 25-point increase. I also happen to think the RBA will do at least 3. I think they'll do one next week, then one in March, and then another one in April. Because I think they've got a long way to go to contain inflation. We saw last week that retail sales were also down, which just means the cost of living pressures are up. And next week, the big earnings period for February kicks off. As you can see here on this calendar, we have about 4 weeks of company earnings. Now, if the markets come in as we think, then the market's actually trading at a fairly respectable PE of about 17.4 times its earnings. However, if earnings potentials are not there and we have a lot more misses than standard, calls, let alone surprises, then, we could see the PE for the market move back to about 24, which is where it was this time last year. Now, I've got a couple of charts of the ASX 200. The first one here is a weekly chart, so it expands the data out by weeks. You can see on the x-axis, we go all the way back to July 2020, and you can see how the ASX 200 has a couple of times reached this sort of ceiling of over 7,500. You can see the peak there in the middle of the graph. That's where it actually reached its high. Now, the ASX, to give you a bit of perspective on the 1 monthly, so this goes back out to 2010, you can see the basic uptrend the ASX 200 has enjoyed, along with a few bumps along the way. And you can see, again, we're just ready to crack out and make new all-time highs. And on the final chart here, this is the 3 monthly, this goes all the way back to 1996. You can just see how the ASX 200 was, back in 96, well, actually 1995, was sub 2,000. You can see that huge run up the market made just before the GFC, and then the big plummet all the way down. And then, of course, it's been rebuilding itself ever since. Incidentally, from that peak in 2008, it took basically until about 2018, virtually nearly 10 years for it to remake that back. And then you can see the big COVID decline, the big rapid rise up, and then that little bit of a decline, and here we are today. So I'd just like to put that out to everybody there, that the ASX 200 is nearing record territory. There's a lot of stocks that make up the ASX 200 that are at record territory. Commonwealth Bank, for example, trading at $110 a share. Now, in my opinion, our market gets fueled on the fact that we have compulsory superannuation, meaning money comes in every month and money just gets invested every month, regardless of the state of affairs of markets. Unfortunately, the big institutional and industry super funds, they just invest straight away into the markets without really any care of sitting back and thinking to themselves, maybe we should wait and just see if there's a bit of a pullback before we invest in. I mean, effectively, I could argue it's nearly like a Ponzi scheme, new money coming in so old money can get paid out, and because it's of a government mandate, being the guarantee and superannuation, it's just a money flow. And of course, the biggest home for the money is obviously our stock market and of course international markets. But the facts are, our market is being pushed up to new highs, and I always get concerned when I see that, particularly when we've got big headwinds in front of us. Namely, we've got inflation that we've not seen since March 1990. That was the last time we had inflation greater than 7.8%. And you know what the RBA cash rate was back in March 1990? It was 17%. Sure, 30 odd years ago, different market, housing prices were different. They weren't multi-million dollar prices they are today. They're only a couple of $100,000. But the facts are, we were in a interest rate environment that was just devastating back in the 90s. Paul Keating, the recession we had to have. And I can't see inflation falling back that quickly. And the RBA, in my opinion, should never have dropped down from 50 basis point rate hikes back in October and November. They should have maintained at 50-point intervals. And had they have done that, I think the CPI for the December quarter, which we came in at 7.8%, could have been lower. So we've got the big headwind there. And of course, this month, as I mentioned, is really, really important on the earnings front. If companies can manage to meet consensus, then the P that we currently see around about that 17.4 times is probably justified. And on that basis, you could argue there's a lot more room to go for the market. Markets do have a tradition sometimes of climbing the wall of worry and just melting up higher. But nevertheless, if it's something you're wanting to put money into, I'm always someone who's very, very cautious. I hate buying things at the top. I just really do. I'd rather wait. Now, sometimes doing that means you miss out because it can keep going up and up and up, and then you look like, a bit of a drop kick. But I think if we get an earnings season that has more misses than surprises, we could see the market pull back. And also, when the RBA announced their ninth rate hike next Tuesday, we'll be interested to see what sort of tone they have, whether they're still maintaining a hawkish tone, meaning pushing for higher rates and longer on a higher rate for longer, or they're going to start to go a bit dovish and maybe give what the market wants, the old pause before the pivot. So there's a bit to watch for this month. I think this is an important month to keep an eye on. Have a list of favourite stocks you would be wanting to get yourself into and position yourself into. But at the moment, I personally would not be chasing this market at all. I find it an extremely difficult market to look for quality stocks because realistically, you are paying literally top dollar. And yet the property market is starting to pull back. Already the Sydney market's down about 13% on aggregate. Sure, there are certain pockets that are doing better than others. Even where I live here on the Gold Coast, there are certain suburbs that are still doing well than others. But the general feeling is the property market's also coming back as well. And our GDP expectations have also been pared back as well for Australia. We're now looking at sub 2% for this year, and that's after being nearly around 4%. So a lot of the key indicators are we're slowing down, and yet the market just seems to think it's happy days, sunshine all around, and we're going to make higher highs. So it's really just a cautionary tale here, just to be mindful of where we're at today. And on that note, we're over 6 minutes. I don't like to keep going for too long on these sort of presentations. But the next couple of weeks will be vital to see just how companies perform. And if they have more misses than surprises, we will start see stocks get a hammering and all that sort of stuff. So thanks for your time. Have a nice weekend. If you liked the video, please hit the thumbs up. Feel free to send the link off to your friends. And until next time, take it easy.